Hello everyone and welcome to this month's special webinar with myself, Craig Erlam, Senior Market Analyst here at OANDA in the UK, in London. With me today is Ed Moya, joining once again from New York, also of OANDA, also Senior Market Analyst. Do you want to say hello, Ed?
Greetings, everyone.
I feel like I may have made the same mistake as once before and muted my laptop. So I'll give you one more go, Ed, just to make sure I can hear you.
Craig, can you hear me?
Okay, again, I'm not sure if this is me or if this is Ed not hearing me, but I'll crack on anyway, and we'll see how this goes. Again, thank you all for joining us. And yeah, I mean, we're looking ahead to what could be, again, just another really interesting month. It's a really weird year in the markets, I'm finding so far, to be honest, because it feels like it's really action-packed. It feels like there's lots going on. It feels like there's lots to talk about. But you look at many of the FX markets, and the volatility just doesn't seem to be combining with the stories. The two things just aren't necessarily lining up. So yeah, it's been a bit of a weird time. I think we are starting to see a little bit of a return. Thank you very much on the Ed point. So he was here. He may have actually left the webinar and joining because he assumed it was an error at his end. But when he joins in, I'll make sure he speaks up, and hopefully I'll hear him. And if not, we'll have to find a way to work through this and just hope it works. But I'm sure it'll turn out to be fine. So yeah, it's been a bit of a weird year, but event-wise, we're not lacking. I think a lot of the central banks becoming more dovish has contributed to the lack of volatility that we've seen in the markets. We saw that certainly in the kind of 2011, 2013 period where everyone had ultra low interest rates, where no one was showing any desire to actually raise them. Volatility really took a hit, and I'm wondering whether a lot of that is contributing to the lack of volatility which we're seeing in FX markets at the moment. Of course, there are other markets that are seeing more volatility. The commodity markets, the oil markets, of course, seeing plenty of volatility there. Equity markets as well. However, that's not necessarily just translating through to FX, and but maybe we are starting to see a change. And I'm personally of the opinion at this moment in time, and I may be proven to be wrong, but there is a lot of pessimism in the markets right now. I think it's potentially overblown, and I think central banks have certainly taken a more cautious approach just in case. And I wouldn't be surprised if towards the back end of the year that starts to change, and that could bring back the volatility if that has in fact been a major contributing factor. But we look at the stories and there's a lot of unresolved. I think we may as well start with this week. I'm not going to go into Brexit this week. We're going to have a bit of a Brexit break. The simple reason being we've not seen any developments here since the delay. The worst thing about the delay was that the sense of urgency had gone. Labour are still in talks with the Conservatives, trying to come up with a cross-party option. The Conservatives are still trying to oust Theresa May, despite having failed on numerous occasions. And we are still no closer to an actual deal that's getting through Parliament. The parliamentary elections are on for the EU on the 22nd of May. Initial efforts are going to be to get something over the line by then. Beyond then, it's the start of July when Parliament sits, and I think there's going to be a lot of opposition to that happening. But ultimately, the real deadline is still end of October, is still when the Halloween, as it conveniently lies. That's still the next ultimate deadline, the next time no deal can potentially happen, technically.
Craig, can you hear me?
So there's not really anything else to say on Brexit. I think the more interesting story this week is the change that we've seen in the US. So trade talks between the US and China have been going on in the background. You can see plenty of reference to this again. I'm hearing that Ed is trying to talk again. Why is this not happening? My audio is very much on. Let me have a play with a couple of things. Ed, do you want to say hi one more time?
Yes, can you hear me?
Finally, it was the settings on the GoToWebinar. I don't know why they reset. I don't know what it is about the settings on this GoToWebinar. Every time I started up, the settings seem to be a little bit different, and it seems to catch me out in one way or another. One time it was my microphone, this time it's the speakers. Anyway, it's great to hear from you. How are you doing, man?
I'm doing great. For not covering Brexit, I think you did a good job of giving it a little bit of a recap there.
Yeah, I think I sometimes need to know when to just shut up and move on, but I can't help but just go on and on about certain things. And Brexit is definitely one of those things you can end up for talking half an hour on, even if there isn't too much happening, just because of all the little tiny things in the background that you read about on a daily basis just seem to take over. So yeah, I mean, so that was Brexit. The US-China trade talks is far more interesting because we've obviously hit a snag. Now, previously, the hope was that Tariff Man, as Dean has referenced him as, had secured a deal. His team had secured a deal by the looks of it with China. They were dotting the I's, crossing the T's, and they were hoping it could be wrapped up by this Friday. All of a sudden, one more Twitter outburst has suggested that that may not be the case. And in fact, tariffs may be coming this Friday instead. How much are you buying into this, Ed? Do you think this is genuine, or is this one final ploy to put that last bit of pressure on China, get them to concede on a couple of final points and push a deal through?
It definitely is. I think textbook Trump. He always asks for more, and then he'll try to settle for a little bit less. But this move was pretty interesting because the main reason why Trump decided to press his foot on the tariff accelerator here is because China initially said they were okay about changing Chinese law. Then they were kind of backtracking those comments. So there is legitimate pushback here, and the market was overly optimistic. I think they're probably over 90% belief that there was going to be a deal done by June, and now this was kind of like a little bit of a reality check here for traders, because the market wasn't properly pricing in the final conclusions of this trade deal. And even as we discuss what's going to happen, what's the likely case, there is, the base case is still that a trade deal will get done, but you're seeing a lot more belief that talks might last a lot longer. There's just some like headlines scrolling right now that the trade talks might drag into 2020. So the more we have of uncertainty, the more that this does not become finalized this early in the summer, that's going to put a dent in risk appetite.
Okay, so that for me invites at least two questions. The first is, will we see tariffs on Friday? Who is this ultimately worse for? Because there was an interesting article that Steve Sedgwick from CNBC posted out over the weekend. We're laying out effectively who is paying these tariffs. Obviously, Trump has repeatedly said we are getting billions and billions and billions from China in tariffs. But ultimately, this article suggested that actually tariffs are paid by the importer, not the exporter. So it's actually the US importers who are paying these tariffs. The question is, who is ultimately footing the bill? And a certain element of that is going to be passed on to the end consumer, which is obviously in the US. A part of that is going to be absorbed by the company, which means lower margins. A part of that will likely be passed on to the producers in China as part of an agreement to offset the increased prices. And then a part of it is also going to be factored into business being taken elsewhere. So it's not as simple as just saying China is paying these tariffs, even if the tariffs are being collected by the US Treasury. So, and there's a reason why Trump has held off on hitting consumer products until this point, because he He's afraid of maybe not necessarily afraid, but he's wary of the impact that it'll have if consumers, voters, start to see the price of clothing or other items going up in the shops and associate it with tariffs, because that's going to be very damaging ahead of the election next year. So again, who's actually really going to be hurt more in this process, and what do you think it means going into 2020, which is a huge year, and one that if he doesn't have a deal over the line, surely something that could be damaging for his re-election campaign. A lot of questions there. Sorry.
No, very much so, and it's to answer the first part is the consumer is definitely going to suffer in the long run. There's historically, when you look at trade negotiations, trade deals, and just the businesses don't bite the bullet. It's always passed on to the consumer, and right now both countries they need a deal done. China has been trying to delay some stimulus because they want to, finally just have a conclusion here. I think there was a big part of the Chinese strategy, though, that was waiting to see if the likelihood of Trump not getting elected was going to be the case. It'd be easier to negotiate with, let's say, a Biden or any of the other candidates. And I think that now that the base case is that President Trump will be, is the slight odds-on favorite to be reelected, China is deciding that, okay, well, we can't punt it that much. We shouldn't wait, because we're still probably gonna have to deal with President Trump. And they're pretty much motivated right now, I believe. This is really preventing them from focusing on developing other parts of their domestic economy. So the incentive is great. Do I think that we'll get an agreement this week? Definitely not. I think there is still too much to be covered and detailed. Will there be enough progress to allow the president to not implement the tariffs? Possibly.
He's backed himself into a corner, though, surely now, just over the weekend, less than a week before the deadline, saying no deal, then tariffs. How does he talk himself out of that?
I think if they can move talks along to have a final negotiation set up with Xi and Trump, that would be acceptable. I think there's just too much. There's just too there. The final points to be reached, as far as the agreements on changing Chinese law enforcement, and I just don't see them being able to accomplish that just yet. I think that where the talks have been progressing, but it's always the finer details at the very end that will require the hardest work. So I think that we will most likely see some progress. I don't anticipate tariffs completely falling, the talks falling apart, but I think we'll probably need to see much more time here, and I think this will drag on a little bit longer.
Okay, so assuming this does go into 2020, we see the 10% tariffs increase to 25. We see tariffs imposed on the final $325 billion worth of imports, including the consumer sector, and then we hit an re-election campaign, and this isn't resolved. How much harm does this do to Trump, or how much good does it do? Is he seen in the US during this negotiation as a tough negotiator that we need to keep a hold of? Or is this a case of this man is unnecessarily engaged in a trade war with the world's second largest economy, and we are paying the price for his dispute, his almost ego-driven dispute?
The political capital is too great right here, and I think that he's very aware that there needs to be a deal done, and he can't let this linger much closer to the elections, mainly because the effects of these tariffs will trickle down. It's not like it's immediately passed on to the consumer. So if we do start to see the consumer feel the pain, it'll feel the pain much closer towards voting time, which is not what he wants. That's why he's making his comical calls for let's cut rates a full percentage point, let's have more QE. He's just trying to provide a backdrop of why, well, if we would have done this, the economy would have been much stronger. It was great during the first 4 years. There is plenty of belief in the growth of the U.S., that it is slowing down and that it's going to continue to head in that direction. So we're approaching the end of a record long cycle, and the economy is still growing, the labor market's still strong, but a year from now things will definitely be a lot softer. And if this trade war is not a tailwind, that is going to be very damaging. So I think the debate, the market is still overly confident that there will be a deal done. We are seeing the repricing of risk, and that's why we've seen stocks and all the high beta currencies, even oil prices, react to the fear that maybe talks are going to fall apart. But I think that there is still optimism here that a deal will be done.
Yeah, his Twitter feed really is quite extraordinary when you think about it. Within a 24-hour period, he can be talking 1 second about the US having its best economy ever, then about the need to cut interest rates by 1% and restart QE. And then there was a retweet I saw over the weekend, I think, suggesting that he deserves a free 2-year extension to his term because of everything the Democrats have dragged him through over the last 2 years with the Mueller inquiry. It's entertaining, if nothing else. But it's certainly you look at the economy right now, and while inflation may be slightly below target, but there is absolutely no need to be cutting interest rates, or especially QE. We almost think of QE now as this standard monetary policy tool. A decade ago, no one used it. I mean, this was an extraordinary measure to deal with the fact that interest rates were basically at zero. This idea that we just use it every time we want to give the economy an extra kick, I feel like we've become too used to it, and we've come too used to the idea that it's just another thing to really help out the economy. But anyway, we'll move on from that. Yeah, I mean, that really does sum up that entire situation quite well. I'm debating in my head now whether to look at a few charts, because the screen's been quite static for too long, and I know that can be quite dull when you're watching these things. Joel, we'll start by very quickly check out the calendar, and then we can move on to some charts, I think, because I really want to look at those dollar charts, because it's been really interesting. Joel, let's do this first. Screw it. Let's move away from what the normal, and let's just check out some charts, because what I found really interesting over the last 24 hours or so, for 36 hours, is that you'll remember, Ed, throughout the trade war escalation, the dollar was king. And the reason that was given to it was that the US in these trade wars had less to lose. They run a large trade surplus, and therefore, if you pick a fight with a large deficit country, ultimately they stand to lose more than you do. Their economy stands to suffer more than yours does, and therefore you're the net beneficiary. And that was very much that's the view that was very much taken. I do also think the fact that treasuries were offering a sizable return of around 3% at that point as well made them something of a safe haven, because equity markets certainly didn't like the escalation. And I think all of these did factor into a stronger dollar. What was interesting is when we saw that initial panic yesterday, and we saw the Shanghai Composite drop 5.5%. We saw the US equity markets, the Dow was off 500 points. The dollar, it was higher, and gold was a little bit higher, but it wasn't much. Why do you think that was? Why do you think FX traders, gold traders, weren't as responsive to it as equity markets?
Unfortunately, the dollar has been, near recent highs. That the dollar has, I'm so used to, covering the dollar, and when we focus on your dollar, just remembering, the targeted range of 120 to 140, and we've seen volatility, pretty much leave the euro dollar pair, and it's right now you have accommodative stances by both the Fed and the ECB. There's no tightening priced in for the ECB until possibly next year. Some people calling for fresh measures of stimulus. The Fed is on hold, and it's been the what's supposed to be the most liquid, the most active currency pair has not provided any key moves here. And while the dollar has has every economical data point that's much better than the euro, the dollar has been overbought in the last few years. So I think that right now it's kind of still been gaining on safe haven flows, but like right now you could see that it's still stuck in a key range, and I think we're looking for that European rebound to kick in. And right now we are seeing the euro tick down a little bit lower as the EU is kind of revealing their spring economic forecast, and we're seeing cuts to their outlooks again. So it's right now it's just kind of like the ugly dog contest, and right now they're both losing. But I think we're gonna hopefully see some improvement though out of the eurozone, and I think that's why we're seeing the dollar have some inability here to strengthen much more.
Yeah, the euro dollar's been very frustrating. Even when we finally break below that kind of 112, and while we have been kind of edging lower, it's not been this kind of straight line. The fact that we didn't even reach 111 and we were already seeing profit taking, it doesn't exactly fill you with hope. I've said on these things previously, and I'll say it again. I can't wait to see a break of 114 if and when we see it. I think it's a breakthrough this side where we're really going to see things pick up. And I think this kind of slow grind to the downside is otherwise just continues, because it really has been a long time now that we've been seeing this happen, and nothing has really given the impression that we're heading in any kind of different direction. And I agree, we see this tariff thing kick off, and the initial reaction was a bit overplayed, but FX markets just didn't really pick up on it. And the same was with gold. And maybe it is the fact that the dollar is already quite overextended to the upside, and we are already at peaks, and therefore any upside for now was a little bit more muted, and maybe that had a lot more to do with it. And you look at this yesterday, and it really didn't reflect in euro dollar. And the other one that I mentioned was gold. Gold was very much the same. We did see a little bit of an uptick initially, and perhaps the dollar get ticking a little bit higher, maybe put a bit of a lid on how sizable the gains were in gold. But I think gold maybe benefited a little bit more from the safe haven aspect that it typically has. But even then, you look at this, even at the peaks yesterday, we're not talking about big moves, especially not compared to what we've been seeing. So nothing necessarily out of the ordinary.
Yeah, gold. I was surprised that we didn't see like at least a $10 bounce higher with gold prices, which kind of shows you the overall just dim outlook people have for that precious metal.
It's really weird right now, gold, because it seems to have a mind of its own in many cases. So we broke through 1280, and we've talked about this before. That 1280 was long-term support throughout the entirety now of 2019, and it almost kind of like an unusual head and shoulders pattern that we had here. So when we broke through this 1280, you really thought it had the potential to pick up, and we didn't even hit 1260. That was the next notable support we had here, and that's where we bring in the moving averages. So you start to think this could be the next key level to the downside, potential rotation point. We don't get close to that. We barely break 1270, and straight again we're heading higher. It's similar frustration to what you see in euro dollar. There doesn't seem to be any such thing as an actual good breakout. Every breakout's disappointing. And even on the retracement back, we came off the 50 fib, and it's like, okay, we just had an early retracement. We can live with that. We come back to the lows. And depending on what platform you're using, if you look at Reuters, Bloomberg, your price is always going to be very slightly different. But on our chart, we were within like a cent of making a new low. I think on Reuters, it was 1 cent, a new low by 1 cent. I'm not sure what it was on Bloomberg. But then we're rotating higher again. Now, this may still be bearish, and it's still waiting to break out. But equally, there's such an enormous amount of indecision right now. And now we're left with just a tighter range. I think 1265 to the downside here, this previous low. If we break through there, then the kind of 1260, 1250 range becomes really interesting as far as I'm concerned. If we can break through the kind of 1290s, then all of a sudden we break through the 50 fib, we make a new high. Maybe that sparks a bit more interest, although ultimately I'd want to see a break through this previous peak. But it almost just doesn't, it almost feels like there's more chance of consolidation again. And we're just in such an indecisive market right now, such a consolidatory market right now, that breakouts seem to be few and far between and a luxury when you find them. Okay, so from that, let's take a look back at that economic calendar. Let's bring it up. We've talked US. What you should see in front of you now is the OANDA MarketPulse website, where myself, Ed, and our colleagues post our content on a daily basis. It's where you'll find a recording of this webinar a little later in the week. Of course, this is a live-only webinar, live accounts-only webinar. So to protect that kind of exclusivity, it will be later in the week when this does go out, which I hope is okay with you guys. I think you can probably get a copy of the recording prior to then if you email webinars@oanda.com. But it is where you'll find it later on in the week. It's also where you get access to the economic calendar and all the other content which we push out, like I say, podcast videos, everything is on here. So I've highlighted basically all the top tier events for the next month for the things that we typically cover. I think the first thing that stands out for me, Ed, is what a quiet month, right? Everything seemed to be front loaded. Of course, we've started today, May the 7th, but you think we are a week into the month. We've had a bank holiday in the UK. We've had a bank holiday in Europe. We've had the Fed meeting last week. We had the Bank of England meeting last week. We had the jobs report last week. We had the Spanish election at the start of the week. Corporate earnings season is drawing to a close. We've had the RBA overnight last night. It's like we've just used everything up by the 7th of May. But there's still plenty to go, thankfully. It just means that the focus may switch. The RBA I actually thought was quite interesting overnight. I don't know about you. Markets were, maybe expectations were a little too high. Obviously, there's the upcoming election, which does cloud things typically. And we very much saw this here with Brexit in the UK, and you see it around the world of elections. Central banks don't typically like to be drawn in to making big decisions, especially decisions that go against the trend just before these key events. And the RBA very much overnight did steer clear of that. There was a high expectation, and I think you may have a screenshot of this, Ed.
Craig, you cut off there for a second. But yes, there was a growing expectation. It was slightly below 50%, where the markets were pricing in that rate cut, and just on the initial release, you saw Aussie dollar rally significantly. Current implied probabilities on the next move, though, for the RBA, only right now at just under 20% for a cut at the June 4th meeting. July is looking at 40%, and then August 6th is right around 69%. So much more higher expectations there. And let me just see. Craig, can you hear me? I just want to make sure you're still on. Okay, great. So hopefully you guys can still hear me. I think Craig's just having some audio issues here. But taking a look at the currency reaction, there has been a much more textbook FX move, where you see an initial just spike higher on the news that, okay, markets were a little surprised, there was no cut, and they didn't really signal that the cut is immediately coming down the road. And but then you notice that they do have an easing bias here, and then we did see Aussie dollar. It has given up roughly half of the gains that it saw overnight. And then taking a look, the next major rate decision, we have the New Zealand central bank, which right now that's interesting because right now the market, last week was pretty much baking in a rate cut, and now those odds have really dwindled down. We're closer to 36.4% right now for a cut for the meeting, which will be later tonight or tomorrow morning, depending where you are in the world. And that's kind of where the markets are right now. Let me. Okay, and it looks like Craig will be back with us momentarily. He just had to restart the program. Another technical glitch there, but Craig will be back shortly. So taking a look at the economic calendar, a couple of key things though that Craig was starting to lead to was that there's been so much data that we've covered, key events, rate decisions at the beginning of the week, out of the month, but what we're really also seeing play an important picture here is the political aspect of things. And while we've seen limited moves for, let's say, the euro dollar, pound dollar, some of the emerging market currencies have a different story. And while yes, the dollar move, the risk off and EM is something that can get wild at times, the domestic stories are important and are providing some very strong currency moves. So when we take a look at what has happened in Turkey, for instance, there's been an interesting development here. President Erdogan, he last month he suffered a very, very important municipal election defeats, and Turkey is a democratic nation, but it doesn't feel that way with President Erdogan. He has another manifestation of his influence over these independent institutions, and he's calling for a redo of the elections that he lost. The reaction, we did see the lira fall to a 7-month low. There was this is Erdogan's authoritarian rule that he's just doing what he wants, and he wants it seems that he's going to redo these votes until the governing party wins again. So you're seeing a lot of risk take place to the lira. Volatility is definitely much higher, and then too, there's also growing concerns that the Turkish central bank they have limited ammunition here to fight the weakening lira. So we could see the central bank be in a position where they might need to raise rates. So there's all this volatility that is starting to take place with the Turkish lira, and this is one currency that when you cover, you could see that a lot of the political stories, whether it was the release of the pastor that was being detained, there was so much political stories that have provided so many of these key moves for the lira, and the moves from last year, were pretty epic. We saw, from going from like 375 and then went almost doubled up to 7.12. So volatility is picking up here, and when we take a look at the last several weeks for the Turkish lira, it has been strengthening pretty steadily. And bear with me 1 second here.
I think I may be back on. Can you hear me?
Yes, Craig, there you are.
My word, I don't know, I've got some technical issues in these things. I swear my laptop works perfectly well every other day of the week, and I sit down on a Tuesday and have enormous amounts of issues. Literally the only thing I ever seem to have an actual issue with is these webinars. I think I'm gonna have to speak to GoTo because it's only when using their software. But yeah, Luckily, I'm back on. I've restarted my computer. I've restarted all the programs. Obviously, I'm not sure where it is that you've moved up to.
Yep. So right now, if you could pull up the Lira chart, we were just wrapping up that. Just kind of we went over the recent developments. Erdogan calling for the redo of the municipal elections that he lost. You know, we saw the Turkish lira sell off pretty hard there, and just kind of one of those emerging market stories that is providing a nice volatile currency move. And when you look at the charts, you could see if you're just more of a technical trader, you know, the lira chart on just 2019 has been very it's been pretty much a one-way move. It's been just grinding higher, and there have been a couple good pullbacks, but you know, the political developments have been really leading that move. And then, you know, just before you went off, Craig, we kind of touched upon the RBA reaction, you know, and just, you know, there is still an easing bias in place. So we did see, you know, that initial, you know, spike higher for the Aussie dollar, and just also then we covered the Kiwi expectations going into tonight's meeting, and just how they've dwindled.
I feel like I was gone for quite so long.
So yeah, so the expectations right now, now only 36% that they're going to cut at tonight's meeting. So lots of you know, important central bank rate decisions that are happening still, and I think that the implied volatility has started to pick up for a lot of these currencies. So that's a positive sign for traders, because it's sometimes when you have some of these tight ranges, it's not the most ideal trading conditions for you if you're trying to capture several pip moves here and there.
Yeah, and as you mentioned, I've got the Lira chart up now. There's no such thing as a tight trading range here, even during this period from January through to March. It almost reminds me of a Bitcoin chart. What looks like a tight range on there compared where anywhere else is actually seen as quite volatile trading conditions. But broadly speaking, even what we've seen this year, it has been on that kind of straight line up. But we've seen quite phenomenal gains throughout that period. It's just you're almost your eyes drawn to this area here. Back in the summer of last year, when things just went absolutely mental, when we were talking about Erdogan taking back powers, taking control, the risk of him effectively taking control of the central bank and what that would do for monetary policy. This is a person who believed that, who's repeatedly claimed that low interest rates is what drives lower inflation, which goes very much in the opposite direction to most forms of thinking when it comes to monetary policy and the link between interest rates and inflation. So we saw this spike up or spike down in the Lira's perspective during that period. So this may look small by comparison, but don't kid yourself. This is quite a move. So what should we move on to next?
I guess I'm just kind of wrapping up with the emerging markets.
Yeah,
the South African rand is in play this week. The general elections right now, the ANC, President Ramaphosa's party, they're expected to win. I think right now, 60% of the seats is what's being eyed. If it's a strong win for the ANC, this will open the door for Ramaphosa to really just drive reform across, and that could be supportive. There is some two-way risk that is starting to be priced in. So when you have that, you know, it provides a good opportunity that you could see some pretty extended moves here post-election. So the rand right now is kind of consolidating ahead of these results, but the overall optimism that it's going to be a clean sweep by Ramaphosa is not the case. So there's, if they get 60% or higher, that's going to be likely supportive for the rand. But if not, you could see there'd be a big concern if the left wings get a good amount of votes and if they form coalitions. So I think if you're mid 60s, you could see the rand really benefit here. And that's kind of where we are at just going into it. So he's expected, ANC is expected to have a good result here. So the question is how good of a showing is the left-wing populist party going to have? So that's going to ultimately determine, I think, the next major move here for the rand.
I mean, we've spoken about this in the past because they've got one final investment grade rating, and they're basically one notch away from losing that. What impact do you think this could have on that? Would a dominant Ramaphosa victory, you think, secure it in the near term and just allow them to keep hold of it and reduce the risk on that sense, or is he potentially being viewed as equally in equal measures as a risk for the that final investment grade rating, and therefore again you would imagine if they lose that, a lot more volatility and softness in the rand?
Yeah, and that's a great point. They're hanging on to that one last investment grade, and if we are going to see Ramaphosa be able to push forward with these measures to really help the economy and help with ESCOM and help with all these other hurdles they have, that is just going to be nothing but positive to help stabilize their investment grade status. The amount of pain the rand would go through if they did get downgraded, that would be pretty severe. You would probably see like 5% initially, and I think that they're just floating here. So this is an important election, and I think that's just kind of going back to that point. The emerging market currencies right now are providing some pretty volatile scenarios where you could see some extended moves. So that's an area that you're gonna see a lot of traders focus on. And then if we do get a lot of positive risk on moves, whether it's from global growth concerns being alleviated, trade talks not falling apart everywhere, that could just benefit these emerging markets.
It's quite amazing to think of a party. Obviously, we have the benefit, I guess, in the UK and in the US as well, where obviously corruption's everywhere, but obviously in certain countries it's less so compared to others. I find it quite staggering, this idea that a country with 26.7% unemployment, enormous inequality, and we have a party looking to be re-elected. You can take a fraction of that unemployment figure, and the chances of being re-elected would be close to zero here, but still clear favourites. It really is quite staggering, the level of hardship so many people feel, and yet it seems to make very little difference ultimately. And when we're looking at the levels on the chart here, that 14.5, 14.75, I think it's quite an interesting level. Like, it's a broad range, don't get me wrong, but when we look back historically, like this goes back to September 2016, and this kind of range 14.50, 14.75. Every time we reach these levels, we seem to reverse off it. There was this brief period here over the summer period of last year, summer going into winter, when we did spike above here briefly. And I think, if I'm not mistaken, that was during an emerging market rout, and South African rand does tend to get hit quite heavily during those periods, being the most liquid emerging market currency. But broadly speaking, that 14.50, 14.75 is really resilient, and that's exactly where we are trading right now. You would think that if we do, for whatever reason, break beyond these ranges, then all of a sudden this is a pair that could become an awful lot more interesting.
No, definitely. Completely agree with you there.
Cool. All right, what should we move on to next? Let's mix things up entirely. You fancy a bit of oil chat?
Definitely. I think we cover it every day.
Yeah, exactly. Non-stop oil. I'm gonna go with Brent, I think. I know WTI is probably the more traded of the two, but there's what I like with Brent is it looks a bit noisy on the chart, so apologies for this. But what I'm trying to bring across on this chart is just how key this kind of 70 area is, because yes, we've got this kind of little rising trend line, and I've added that just for a little bit of extra, really, just to show how many things are combining at this point. I can even remove this; it's not really that important anymore. But you've got this area here around this kind of 68 through 70 level where we were continuously running into resistance previously. Once we broke above, we found support on here. You combine that with a couple of moving averages that we've got here. That's the 200, 233, and moving averages, which again, not many people use them from what I know, but this are the ones that I always have on my charts. And for those of you who join here regularly, I personally quite like them. I use fib in a lot of what the technical analysis that I do, and I think it's quite effective from a moving average perspective as well. Again, that's from my personal experience. And the fact that these two combine here, and the 200, a lot of people use. So even if you just take that one on its own, so you've got the 200, 233, you've got the rising trend line here, you've got the prior area of support and resistance. This just strikes me as a really interesting zone, because I feel like if we move below here, there is potential for this to become much more of a sharper drop off. And if we look into when this decline first started, this actually started with a Trump tweet again. Trump suggesting that he called OPEC and effectively demanded that they lower prices and stop artificially inflating the price of oil by reducing output. Now, I don't have the number for OPEC personally, and there has been denials that these calls took place from OPEC, from within OPEC and Saudi Arabia. However, it did, from my perspective, I'm not sure if you agree with this, Ed. For me, all it did is signify that this market was very toppy around the $75 mark. And it's almost as if Trump saw an opportunity to dent prices while being seen to be taking action. Now, that may just be the skeptic in me, and you see how these markets can often work and how little a nudge it can take to get an outsized reaction when these markets are overstretched. And I can't help but just feel that this was more an accurate reflection of what's happening, because he's threatened a lot in the past when it comes to OPEC, and so far there hasn't actually been any follow through.
I think that his timing was ideal. Whether or not I mean, he might, on some days he's sending about like 20 to 50 tweets a day. I don't know if that was just what was on his mind, but the timing was perfect. And I think that for myself, I was kind of viewing, it definitely did seem like it was ready for a pullback. And I thought that the overall OPEC Plus production agreement, I thought that there was going to be some growing skepticism that it was going to get extended. I thought that with the sanctions, we were going to need to see, the big players ramp up their production, and just there was going to be a little bit of cloud of uncertainty as we approach these key meetings for OPEC. They have the JMC on the 19th, and then next in June they have the 176th ordinary meeting at I think June 25th. So there's lots of focus that's going to be on OPEC, and I thought that there was going to be a good chance to see risk come off here, but his timing was really, it was ideal. I think Trump delivered a strong message in the past, and he has signaled lots of sell-offs for oil. If the market's looking toppish, Trump gives you a reason to sell. I think the market's embraced it, and here we are.
Yeah, I mean, it's not necessarily me trying to be a skeptic with regards to these Trump comments. It's more a case of, for like him or loathe him, for his positives and negatives, if there's one thing he is good at, it's surrounding himself with some very intelligent people. And he's surrounded himself with some people who have a lot of experience, decades of experience on Wall Street. And we know there's two things he seems to be obsessed with. One is equity market valuations, record highs, etc. And the other is oil. And the skeptic in me just saw these comments and thought it's a very convenient time to be doing it when everyone's talking about oil looking very toppy. I wonder if maybe Steve Mnuchin or one of the other Wall Street former executives had a word in his ear and said, you may want to mention something about oil because this is looking prone to a drop. And again, it just gives that air of authority, this idea that he's an influential player in the oil market. But again, I think the more years you spend in this game, the more you become a cynic. And maybe I need a holiday, and maybe I'm just allowing myself to get too caught up in the games that you can often see being played out here. In terms of where we're heading from here, I actually wouldn't be surprised to see more of a corrective move. I feel like this has been an unusually straight line up really since the start of the year. The sell-off at the back end of last year really took a lot out of the market, and we saw that in the equity markets as well. And I think this run-up we've seen recently has potentially been outsized compared to what the actual developments have been. I still think there's a lot of two-way price action to be had, because for all the bullish factors for oil, and with that you can include a number of different things, from Saudi and Russia-led OPEC plus output cuts to the Iranian waivers being allowed to expire last week, Venezuelan output, all of these things. There's plenty of downside input as well, and that includes record US output spiked to 12.3 million barrels a day at the back end of April. You can include slower global growth expectations within that as well, and also the potential for, as I already alluded to, the output cuts not to be extended to the end of the year. Russia is a clear risk here. We've seen certainly comments that suggest that there's not that much desire to actually extend these from Russia, that they're quite content with these oil prices at these levels. So for all the upsides, for every upside, there seems to be a downside risk factor. And I wonder whether we've just become a little bit overextended to the upside here because the downside prior to the end of the year was so severe. The fundamentals are obviously very similar as well for WTI. I think the inventories are playing a big role in this as well. The difference with WTI is we've actually seen a break of this trend line that we consolidated around here last week. Again, we're testing that moving average combination with this prior area of kind of support and resistance here around the kind of 61, 62s, which I think is interesting. If we do see a break below here, then I think maybe 57, 58s could be a very interesting area. Again, if you look during this period here, support and resistance was quite key. And yeah, I mean, I think there's potential for a little bit more downside here, but I guess we'll very much have to wait and see here. Let's get back to FX, and you say you covered the RBA decision, the spike that we saw in the Australian dollar. You didn't bring up a chart though, right?
No, that is correct.
So the Aussie dollar, I mean, again, I find this, you go through periods, and you may be the same thinking, Ed. I certainly do, especially when you're at periods of consolidation, which frustrate the life out of me. And there's the way I want the market to move, and this isn't just when you've got a position and you want it to go in favor of your position. There's the way you want the market to move, and there's the way you think it probably will develop. And I talked about it with Euro dollar just then, in that it looks as though the market's just going to continue to grind lower unless something significantly changes. What would be best for the market from a volatility perspective and from an interest perspective would be to break through 114, and that could potentially have the potential to be the catalyst for a nice big move higher, or at least a lot of volatility around that point. I feel quite similar about the Australian dollar, US dollar. For some time, the path of least resistance has looked to the downside, 70 through 71. Every time we get into that area, we seem to find a reason to rotate higher, barring the flash spike that we saw in the yen, or the flash crash that we saw in the Australian dollar. What I'd love to see is a breakthrough 72, because I think when you've got this combination, you've got the moving average band again, which is kind of cushioning the blow all the way down. You've got the descending trend line, which we've stayed below. And obviously, you've got the most recent peak as well, the most recent 2 peaks as it were around 72. A breakthrough 72, I think, could really bring this back to life. Unfortunately, as you can see in the chart, it's 70 that looks the most vulnerable to me.
I think everyone has been focused on 70 for quite some time, and definitely one of the key catalysts. You have the RBA with an easing bias, you have the Fed on hold, and I think the optimism on the trade deal is not necessarily going to give a tremendous boost for the Aussie dollar. Yes, it'll help the commodity currencies, but it's not like the old days when we saw a much more stronger reaction for the Aussie dollar. So the downside risks are still pretty high here.
Yeah, and with domestic policy becoming decidedly more dovish, even if the RBA has held off for now, it certainly is just another risk factor. And like you said, the link between Australia and China isn't as big as it used to be, but we do still see correlations between the two at this moment in time. And it seems that there's various developments which just seem to be more negative than positive at this moment in time for the Aussie dollar. Let's look at some yen. We haven't covered any yen yet. There's not really much to talk about from a Bank of Japan perspective, right? They are very dovish. They are heavily engaged in QE. I'm surprised there's a Japanese bond out there that they don't already own, and there's nothing that seems to be changing. There's the potential that they could look for and engage in more stimulus if the situation deteriorates further. I'm not entirely sure what it is that they've got planned here. Maybe it is a negative target rate for the 10-year yield or something like that, for the real 10-year yield. But broadly speaking, they seem to have really reached the limits of what they can do, and yet nothing's really worked. So how does this play out for the yen? Because somehow it seems to be well supported, even in a general risk on market, and even against a softer currency like the euro.
No, you explained that nicely. I think that they're on persistent easing is their game, and they're unlikely to really, I think, have any major policy changes until the spring. So it seems like it's pretty much baked in what they're going to be doing, and the one expectation is that we might see more easing. So it's not much of a catalyst on the Japanese side here.
Yeah, and it's really, again, just another sign of the markets that we're seeing right now. Two things, moving averages and Ichimoku. They're both trend following indicators, so they can be signs of a bullish or a bearish market. If price action is above, it's a bullish signal. If it's below, it's a bearish signal. And it can also be areas of support and resistance during these trending markets. Well, when this doesn't apply is when you're in a range-bound market, a sideways trading market. And as you can see, what happens then is price action just chops between the two, and it gives you fake signal after fake signal after fake signal. And again, this is just another sign of where we are. We've got kind of the upper end of the range around 127, 127.50. That's been very much the case now since the back end of last year. You've got the bottom end of the range, barring the flash spike in the yen, around the kind of 123.50s, 124s. And it looks as though the bottom end of that is coming under a little bit of pressure, but once again, we're just running into support here. So it's not really filling you with hope that much is going to change here. The US dollar, we saw a brief move above that kind of 112, but it just couldn't hold. I've got this descending trend line on there, but it's very much more speculative. There is 3 touches, so technically it is a good trend line, but I'm more looking at just for signals that we are actually breaking higher, and we're just not seeing it. 110 remains key support for me to the downside, that 110, 109.75 area. Again, the Ichimoku cloud. How much do you want to use? How much do you buy into it in these kind of edgy sideways markets? We basically just saw the lagging line fall through the Ichimoku cloud from below to over previously, which doesn't exactly spur confidence. And yeah, I think break 110 could be a little bit bearish, but really it's just a very choppy market. I think sterling's probably among the more interesting of the currencies right now. But even this against the yen, we're just seeing downside pressure building. And I've said in previous webinars, nothing's really changed because Brexit is exactly the same. The central bank wants to move, but it can't. Its hands are tied by Brexit, the uncertainty that creates. The environment it's in right now, the UK globally, is less positive, and Brexit is uncertain. So the hands are tied. And I think what we've seen since it became clear that we were heading for an extension is just a little bit of profit taking. It's not been enough to take us through these kind of 144s, which may have made this pair exciting, but that may follow. But it means that, again, we are just range bound, tighter and tighter ranges. It's looking a little bit more interesting against the US dollar. But even then, we see this little ride higher. And we saw the move higher on Thursday. We saw a couple of things. We saw the Bank of England, which was much of a muchness, really, even though it was Super Thursday when we got all of the information, the forecasts, the press conference, etc. But then we also had signs early in the morning. It was around 7 a.m. and we had reports from both within the Labour camp and the Conservatives camp that the cross-party talks are actually progressing well and the progress was being made. And I think that's what really drove this higher for two reasons. One is this hope, although it seems very stretched now with 15 days to go until the EU elections, this idea that we could get a cross-party agreement that passes through Parliament and is acceptable by Brussels, but also a cross-party agreement that would be a softer version of Brexit than Theresa May was initially proposing, which again, you would imagine would be a sterling positive event. But already that's starting to add a little bit of steam. There's a lot of opposition to it on the Conservative side. Theresa May's constantly being asked to resign by various Conservative MPs in the media. Her job is constantly at risk, but it has been for 2 years. She's probably used to that by now. But it's made sterling one of the more interesting currencies, I would say, against certain other currencies. Clearly not the yen so much.
As far as Brexit goes, I think right now it's just talks. They just need to see an agreement on a compromise, or do you think we're going to get that referendum or emergency general election?
Honestly, I feel like I've got a seven-sided coin right now, and you could toss it in the air, and it would have as good a chance of predicting the outcome as I do. I don't know if I'm stubborn or stupid or ignorant or ahead of the curve.
I have a Liverpool joke, but I'm not going to go there. Sorry.
I'm sure everyone does, to be honest. I've heard them all by now. I still have a feeling somehow Theresa May's deal isn't dead, and there isn't much support for it. But one thing that these talks with Labour is doing is it's spreading fear throughout Brexiteers and throughout the Conservative Party that Brexit is at risk. And I still wonder whether, given one more opportunity to back it, they seize that opportunity to avoid another referendum, to avoid a cross-party coalition agreement that, in their mind, undermines the referendum altogether and prevents them ever getting the Brexit that they want, something that Theresa May's deal, broadly speaking, would allow once you're out the other side of the backstop. So I'd say in terms, I'm finding an agreement. I don't think anyone really knows how this is going to end. But for some reason, there's part of me that just doesn't think Theresa May's deal is dead. And yeah, but who knows when that's going to come. And I've said repeatedly, I'm enjoying the break. I really enjoy talking about other things than Brexit and reading about other things than Brexit. So hopefully we can see through the summer, we can get some nice weather, have some nice chat, and to get back to the Liverpool thing, it will probably take me a few months to recover from what is to come over the next week for myself and my fellow fans who have enjoyed 9 months of a fantastic season. and the final 2 weeks of what could be just horrific to watch and experience. But the upside and downsides of being a sports fan, I guess you could say.
Definitely. Well put there.
All right. Well, on that note, I'm sure many of you did sign up just for this kind of footy chat, or soccer if you're joining from the US. But yeah, I think we'll wrap things up there. We've gone a little bit over, but we did have the disruptions due to what I'm going to blame on GoToWebinar, and yeah, I'm just going to blame GoToWebinar. I'm not going to take any responsibility for that. But yeah, we'll wrap things up here. We've got no questions coming through now, so let's do that. Thank you very much all for joining us. As I say, you'll be able to find a recording of this on the website and on YouTube and on Twitter later on in the week. If you do have any questions that you've thought of now or later, feel free to reach out to me on Twitter. My Twitter handle is Craig_Forex, and Ed's is EDJ Moya. Is it, Ed?
Exactly.
My memory is not altogether gone. And yeah, apart from that, join us again next week for another session. Thanks, Ed, for joining us today. A pleasure as always to have you on.
Thanks for having me, Craig.
And I'll catch the rest of you guys very soon. Thank you very much.